I need to share something with you about the strategy that has defined my entire career, something that most people don't understand, something that challenges everything you've been taught about markets, and something that threatens not just individual portfolios but the very stability of the global financial system. I'm George Soros. You may know me as the man who broke the Bank of England in 1992, making over $1 billion in a single day. You may know me as a hedge fund manager who generated an average annual return of 30% over 30 years with the quantum fund from 1972-2000, turning $12 million into over $25 billion. Or perhaps you know me as a philanthropist who has given away over $32 billion to promote open society. But what I really am is a philosopher who happens to understand financial markets. And what I understand, what I've built my career on understanding, is that markets are always wrong. Not sometimes, always. The only question is, by how much? Before we continue, I encourage you to subscribe to this channel. The ideas we discuss here challenge conventional wisdom and are based on decades of experience that have fundamentally changed how we should think about markets. The strategy I'm about to share isn't about technical indicators or fundamental analysis in the traditional sense. It's about understanding something called reflexivity, a concept that will help you understand not just my success, but every financial crisis and bubble in history. Most economists believe that markets move toward equilibrium, that prices reflect fundamental reality. They're wrong. Markets don't just reflect reality, they help create it. The participants' perceptions influence the fundamentals, which in turn influence perceptions, creating a self-reinforcing feedback loop. And understanding this process, this is what allowed me to see what others couldn't. By the end of this video, you'll understand the philosophical framework that has guided my investment decisions for over 60 years, why traditional economic theory is fundamentally flawed, and what you need to do to think like a legendary investor. Let me start with a proposition that most economists reject. Markets are always wrong. They don't reflect reality, they help create it. My quantum fund achieved returns that seemed impossible to traditional economists. Average annual return, 30% from 1972-2000. Some sources report 35% annually from 1969 to 1994 in single years during the 1970s. Over 100% returns. Peak assets under management, $25 billion. Conventional theory says these returns are impossible in efficient markets, but what I understood was reflexivity at work. Let me explain. There are two functions in financial markets: the cognitive function, where participants try to understand reality, and the participating function, where their actions change that reality. When these interact, they create feedback loops that take markets very far from equilibrium. This is not a free market correcting itself. This is a self-reinforcing process that creates booms and inevitable busts. Understanding fallibility is crucial. I studied under Karl Popper at the London School of Economics in the 1950s. Popper taught me that human understanding is inherently imperfect, what he called the human uncertainty principle. The participants in markets are operating with imperfect understanding. They don't see reality as it is, they see it through biases and misconceptions. In situations that have thinking participants, the participants' views of the world never perfectly correspond to the actual state of affairs, and these misconceptions aren't passive. They actively shape the reality we're trying to understand. My conceptual framework is built on two relatively simple propositions: fallibility and reflexivity. As I say, the two principles are tied together like Siamese twins, but fallibility is the firstborn. Without fallibility, there would be no reflexivity. Here's the mechanism. When a trend develops based on a misconception, that trend changes the fundamentals in ways that initially seem to confirm the misconception. This creates positive feedback. For example, in credit markets, rising asset prices make borrowers appear more creditworthy, which allows them to borrow more, which drives prices higher, which makes them appear even more creditworthy. The participants' perceptions are influencing the fundamentals. The trend is built on a misconception, and when trends are built on misconceptions, they eventually collide with reality. That collision is what we call a crash. This is why I say financial markets, far from accurately reflecting all the available knowledge, always provide a distorted view of reality. This is the principle of fallibility. The degree of distortion may vary from time to time. Every bubble has two components: an underlying trend that prevails in reality and a misconception. Relating to that trend, when positive feedback develops between them, a boom-bust process begins. The process is tested by negative feedback along the way, and if it's strong enough to survive these tests, both the trend and the misconception will be reinforced. Markets are in a constant state of divergence from reality, meaning prices are always wrong. Let me show you how reflexivity works in practice with the trade that made me legendary. By 1992, Britain had entered the European exchange rate mechanism, agreeing to keep the pound within specific bands against the German mark, roughly 3 marks to the pound, or 25 baht to the dollar. But here's what mattered. Britain's economy was fundamentally incompatible with this peg. UK unemployment spiked to 12.7%. From 7.7% 2 years prior, Germany needed high interest rates to combat post-reunification inflation. Britain needed low rates to fight recession. The pound was trading at levels requiring interest rates too high for Britain's weakening economy. There was a real problem at the core: an unsustainable currency peg. The misconception was that the Bank of England could defend the currency indefinitely. The government had made promises. National pride was at stake. Politicians believed they could hold the line, but I understood something they didn't. They were fighting against a reflexive process. In May 1997, the Thai baht came under massive speculative attacks. The pattern was forming. By September 15, 1992, Bundesbank President Helmut Schlesinger made an offhand comment that one or two currencies could come under pressure. The market interpreted this as referring to the pound. I struck with overwhelming force. On the morning of September 16, Black Wednesday, my fund increased our short position from $1.5 billion to $10 billion. We borrowed and sold pounds from anyone who would deal with us. The Bank of England found itself in an impossible position. Trading rules required them to accept any offers to sell pounds during trading hours. They spent billions buying pounds, purchasing 300 million pounds twice before 8:30 a.m., then billions more throughout the day. They raised interest rates from 10% to 12%, then announced they would go to 15%. Nothing worked. We were dumping pounds faster than they could buy. By evening, Britain withdrew from the ERM. The pound lost 9.5% of its value in a single day. The Bank of England lost 3.3 billion pounds. My fund made over $1 billion. Some called it an attack. Prime Minister Mahathir of Malaysia later accused me of deliberately destroying Asian economies. This fundamentally misunderstands what happened. I didn't create Britain's economic problems. I didn't force them to join the ERM at an unsustainable rate. I didn't make Germany raise interest rates. What I did was recognize that the perception that the pound could be defended was divorced from the reality that it was fundamentally overvalued, and I understood that when perceptions and reality diverge this dramatically, reality will eventually win. This is what I mean by reflexivity. The British government's commitment to defend the pound was itself a factor in the market. Their actions influenced prices, but ultimately the underlying fundamentals reasserted themselves. As I later said about the 1997 Asian crisis, I don't think it was so much the speculators attacking the Thai currency at the outset. There were a large number of private loans to Thai borrowers in foreign currencies. The debtors depressed the local currency. The fall caused losses, which then reinforced the decline in the stock market. What concerns me most is not just the profit opportunity, but what these crises reveal about systemic fragility. The amount of money sloshing around global markets is so enormous that it can bring even the British government to its knees in one day. In 1997, what started in Thailand spread to Indonesia, Malaysia, South Korea, eventually threatening the entire global financial system. These aren't isolated incidents. They're symptoms of a deeper problem. Our economic system creates conditions for reflexive boom-bust cycles that destroy wealth, create unemployment, and threaten democratic institutions. When the 2008 financial crisis hit, my understanding of reflexivity enabled me both to anticipate the crisis and to deal with it when it struck. While traditional economists were blindsided, I had been warning for years that the housing bubble was built on a misconception. In the reflexive process, we typically see these stages. Stage 1, the trend and underlying change begins in reality. Stage 2, the misconception, participants misinterpret its sustainability. Stage 3, the boom misconception and trend reinforce each other through positive feedback. Stage 4, the test reality pushes back with negative feedback. Stage 5, the climax, if the trend survives the test, conviction strengthens. Stage 6, the reversal. The trend becomes unsustainable and collapses. The key to successful investing is recognizing which stage you're in and being willing to reverse your position. As I describe my strategy, we try to catch new trends early, and in later stages we try to catch trend reversals. Therefore, we tend to stabilize rather than destabilize the market. It is our style of making money. Here's what most investors miss. They doubt the persistence of reflexivity and the relative infrequency with which collective errors are corrected. They exit trends too early. When I see a bubble forming, I rush in to buy, adding fuel to the fire. That is not irrational, it's understanding the self-reinforcing process will continue longer than people expect. But, and this is critical precisely because trends go to extremes, you must watch for inflection points. As I put it, I look for the flaw in every investment thesis. I am ahead of the curve. I watch out for telltale signs that a trend may be exhausted. Then I disengage from the herd and look for a different investment thesis. The numbers demonstrate this isn't theory, it's proven practice. 1992 British pound, over $1 billion profit in one day, 1,997 Thai bahts. Quantum Fund profited from the Asian crisis, 2008 financial crisis, anticipated and navigated successfully 30-year average returns, 30% annually. These returns came despite wars, recessions, flash crashes, and inflation. They came because I understood something fundamental that traditional economists reject. Today we see reflexive processes everywhere. Tech stocks where rising prices enable companies to attract talent through equity compensation, strengthening fundamentals, driving prices higher. Credit markets where central bank intervention has created moral hazard. Asset bubbles built on the misconception that central banks will always prevent collapses. The question isn't whether these trends will reverse. The question is when. My understanding of fallibility means I know I can't predict the exact timing, but I can recognize the pattern. I can see when misconceptions have driven prices far from sustainable levels, and I can position accordingly. As Jesse Livermore once said, "It was never my thinking that made the big money for me, it was always my sitting." Understanding that most investors only earn a fraction of what's available in any strategy, well, a fraction of my 30% annual returns is still far superior to a fraction of market returns. Let me tell you what you need to do both to profit from reflexivity and help preserve open society. First, embrace fallibility. Recognize your understanding is imperfect. Mine is too. There is no shame in being wrong, only in failing to correct our mistakes. This recognition is wisdom, not weakness. It's what allows you to change your mind when evidence changes, rather than clinging to losing positions out of pride. Be flexible, adjust as new information emerges. I'm not better than the next trader, just quicker at admitting mistakes and moving on. Second, understand reflexivity in your decisions. Your actions are part of the system. Ask yourself, am I following a trend because it makes fundamental sense or because others are? How might my misconceptions be shaping my decisions? What feedback loops am I participating in? Where do perceptions most diverge from underlying reality? Third, position for the reflexive process based on the boom-bust cycle framework. When entering a trend early, size positions aggressively when conviction is high. Add two winners as the reflexive process strengthens. Don't fight the momentum of positive feedback when trends mature. Look for tests of the trend. Watch for signs the misconception is being challenged. Begin preparing exit strategies when reversal approaches. Disengage from the herd. Consider contrarian positions. The reflexive process works in both directions. Busts can be as extreme as booms. Key principle: when I identified the pound trade, I didn't place a modest bet. I went to $10 billion. When you have high conviction based on understanding reflexivity, size your positions accordingly. Fourth, watch for these indicators. Look for divergence between market prices and underlying fundamentals, participant beliefs, and economic reality, short-term trends and long-term sustainability. Policy commitments and economic constraints. The British pound was a perfect example. The government's commitment to defend the currency diverged from the economic reality that it was overvalued. Fifth, think systemically. This is a policy problem requiring political engagement. Support institutions that recognize market fallibility. Prevent excessive boom-bust cycles. Maintain transparency and accountability. Protect open society from systemic collapse. Don't just protect your interests. Support policies that reduce systemic risk and prevent the kind of cascading failures we saw in 1997 and 2008. Sixth, master risk management. The question isn't whether you'll be wrong. You will be. I am frequently wrong. The question is, how much do you lose when wrong, and how much do you gain when right? Position sizing is everything. When the pound trade presented itself, I could be wrong, but if I was right, the asymmetry was enormous. That's when you bet big. Let me conclude with the two ideas that have guided my life: fallibility and reflexivity. We cannot know reality perfectly. Our understanding is always partial, distorted by biases and limitations. In financial markets, this isn't just an academic point. It creates massive opportunities for those who recognize it. And our perceptions don't just reflect reality, they help create it. The feedback loop between thinking and reality drives boom-bust cycles that traditional economics cannot explain or predict. The strategy that made me legendary wasn't about being smarter than other traders. It was about having a different conceptual framework. While others believed markets were efficient and moved toward equilibrium, I understood they were always wrong and prone to extremes. This understanding allowed me to make $1 billion in a day against the Bank of England. It allowed me to generate 30% annual returns for 3 decades. It allowed me to anticipate the 2008 crisis while traditional economists were blindsided. But more than making money, this framework revealed something important about our world. Markets are not self-correcting mechanisms that ensure optimal outcomes. They are reflexive systems prone to excess, requiring thoughtful regulation and constant vigilance. The conceptual framework of fallibility and reflexivity has helped me make billions. More importantly, it's helped me understand the forces shaping our world, the boom-bust cycles that create and destroy wealth, the systemic risks that threaten financial stability, the importance of open society in managing human fallibility. I hope this framework helps you understand markets differently. More than that, I hope it helps you become the kind of investor and citizen who thinks systemically about risk, embraces intellectual humility, and works to prevent catastrophic collapses. The future is uncertain, but understanding the reflexive process gives us agency. We can recognize misconceptions. We can position for reversals. We can profit from the inevitable boom-bust cycles while working to moderate their extremes. Markets are always wrong. The question is, will you be among those who understand why? Thank you for watching.